And welcome back to Kyle Talks, where I'm Kyle and we talk. I have a great conversation planned for you today, and that conversation is with Adam Link. He is the CEO of Fireweed Capital, which manages over $600 million of assets. And he sees the economy how most really don't. Today, what we break down is we go over what's happening right now beyond the headlines and what does it mean for finances, for wallets, what's going to go up in price, what's going to go down in price. What are people getting wrong and what you need to be paying attention for if you want to be prepared for your future when it comes to finances. He had a lot of wisdom. This was such a great conversation. Now, please enjoy my time with Adam Link. Adam Link, welcome to the podcast.
Yeah, thank you. Great to be here.
Uh, let's just jump right into it. You manage $600 million. How did you sleep last night?
I actually sleep pretty well. So yeah, I should say, I'm one of a team of folks that helps with that $600 million portfolio. But no, I sleep pretty well. So it's one of the things I've learned throughout throughout my life is that numbers are just that.
Yeah.
Um,
Yep.
$100 is a lot of money to some people. $100 million is a lot of money to some people. And the converse is true. $100 may not be much to someone who has a lot. And really, at the end of the day, whatever number, whatever unit follows that number, it's just a unit of measurement.
Yeah.
It's much the same whether you're looking at billions or trillions or hundreds.
Big agree. That's was taught to me a lot. It's just a unit. Don't make it weird. A lot of people do, understandably, because it's money in whatever context is a lot to you. Um, but you and a team, Fireweed Capital, talk about what your business is. What do you do? How did you get into this? It's very interesting.
Yeah, yeah, certainly. Yeah, so Fireweed Capital is my wealth management firm that I started a few years ago. And we actually, so that $600 million number is our portfolio management firm that we work with that handles, basically a lot of how we do our investing. And we really aligned with them, and we joined forces, and we really take an active, managed view to the world. And for me, how I kind of got into this was a history in finance. Did my undergrad in finance, and then got my master's and my doctorate in computer science, and found that I was the person who was basically talking a lot about finance to everyone in tech. And one day said, I should really get paid for this. And so I decided to become a licensed financial advisor, which is what you have to do in the US in order to get paid to give financial advice, and did that. And, kind of been growing the practice ever since. But really, yeah, the overlap of tech and finance is really kind of what drew me to this idea of there's got to be a better way to invest in the markets than just kind of sitting there passively and saying, I'll take what comes to me. That never sat well with me. And so what we do at Fireweed Capital is take an active stance on the market. We believe that you can look at the way the markets are going, and you can come up with a theory as to whether or not the market's going to do certain things, and then you can invest according to that theory. And sometimes it plays out right, and sometimes it does not play out the way you want. But we think that that's better to do than just say put it all in an index fund and walk away for 20 years.
Perfect segue. You're also a published author, and I checked out some of your books, specifically Index and Regret. And this flies in the face of all financial advice. Set it, forget it, buy SPY, VOO, whatever, index funds. Why do you think, what are some drawbacks with that? Why not do that? Isn't that safe? And if not, why not?
Yeah. So you're right. I do not hold a view that I think a lot of financial advisors hold, which is indexing low cost index funds is the best way to invest. And really, there's a couple of things that form that view, right? The first is there's this joke in the finance industry that the two best classes of investors every year, and they pretty much don't change year over year, the two best classes of investors are those who forgot they had money invested and those who are dead. And I think that points a lot to human psychology, right? That if you don't remember that you have money invested or you are physically unable to do anything about it, you do well year over year. And the reason for that is an academic study called the Dalbar study. It's released every year, which basically looks at the returns an average investor gets versus the returns of the market. And the returns of the market are always, pretty much every year, consistently 1% to 2% higher than the returns of the average investor. Now you might say, okay, well, why is that, right? If all we're doing here in passive investing is buying the market and letting it sit,
Yeah.
why is it that on average, the average investor gets a lower return than the market? And really, it comes down to human behavior. The markets go up and down every day. And in the last year, we're seeing market fluctuations every day of 1, 2, 3% per day. And when the market fluctuates down long enough, people end up doing what is called capitulating, which is they give in. And so they see their money going down and down and down in their portfolio, and eventually they say, "I've lost so much money, I just need to sell it all and go to cash."
Yep.
And that behavior right there, that is what breaks passive investing. The minute you sell when you're down, you have basically blown up the entire premise of passive investing, which is buy it, hold it, don't do anything with it, and come back in 20 years. And the reason that's so hard to do is humans want to do something. We are not passive by nature, right? We want to do
Yep.
something. We feel like we can control more than we can. And so when your money's
Yep.
down in your portfolio, you go, well, I got to do something. I got to do something about this, right? And doing something is what breaks passive investing. So realizing that there's very real human limitations, very real psychological limitations, and very real academic studies that show that people don't do passive investing well. I said, well, the other option then is active investing. You have to have a view. You have to do something. And so it then becomes a question of, well, can we find a group to work with that does something well enough? Right. And that's kind of
Yep.
the thesis that led to me writing Index and Regret. And then kind of the follow-up book, Better Than Average. And Index and Regret is very much an academic focused book, and Better Than Average is more of a layman's book, right? So
Sure.
I try to take a little bit more
Sure.
of the academic out of it
Yeah.
as much as I can. Yeah.
Yeah. That intrigued me because I'm like, whoa, I'm sure you know that as contrarian. You don't hear that too much, specific with that. And my question, going through reading and going through your website, um, the market, there's a word for it. I'm gonna say androgynous, but I can't think. It's a collection of everyone's opinions, mainly held by the really wealth financial advisors, things like that, hedge fund managers. But regardless, still like an active. Here's what everyone thinks their thing with their dollar. So it's hard unless you got some like future knows site or something to know where it's gonna go or how people are gonna react, things like that. So on your website, and you talk about this a lot across all different avenues, is the warning signs and being able to be active, moving funds, whether that's stocks, whatever that is for you guys. My question is that really, is that, how is that beneficial? Because obviously you've been doing this for a while, but there's going to be some red days, no?
Yes. No, there definitely are. And one of the things that is important to realize when it comes to actively managing a portfolio, right? So we do what we call is active risk management. And basically the idea there is we are not trying to outperform the market.
Mm,
One of the things that a lot of people think about active management is, we're all out there trying to beat a benchmark. And the reality is we're not trying to beat a benchmark every year.
yeah,
What we're trying to do is we're trying to lose as little money as we can when the market goes down. And then we're trying to get as much of the upside as we can when the market goes up. And that is fundamentally different than trying to beat the market every year. And the
yeah,
reason for that is our first thing, and on our website says this, guard first, compound second.
yeah,
That's really the goal behind the way that we manage funds. Is that the first thing we want to do is we want to guard against the downside, because that's where human psychology takes over and blows up financial plans for people.
Yeah.
is really at the end of the day, if you're losing money, and as an aside, when your portfolio goes down in value, you actually haven't lost any money.
Yeah.
Um, right? Because
Yep.
what you lost is value, but you
Correct.
still hold the same number of underlying shares. And so
Yep.
the minute you take action on that number, then you lock in your loss,
Yep.
right? And now you've actually lost money. But that is a very hard thing for our brains to comprehend when we're seeing that, we're down $300,000. It feels like we've lost. Well, you've lost value, but
Yeah.
you haven't lost anything really.
That's the human
Um,
psychology. Not to interrupt, but to add, I think I was reading. My wife is a therapist; she understands. But I was reading an intelligent investor. I think it talks about this too. But the pain of losing is twice as much as winning. So when you see, yeah, it's human
yep,
psychology. Yeah,
yep. No, that's exactly right. And human psychology drives a lot of how we think about financial planning, because at the end of the day, I can lay out the best plan for you, but if you can't stick to it through a market drawdown, that's not a very real plan, right? So, yeah, that's really the thing that we think about a lot is when the market goes down, how can we avoid taking those, same dips? And so one of the ways that we look to manage against that is the portfolios that we use can go to cash. And so we will look at warning signs in the market and we'll say, okay, we think that we're going to go down. And we trade multiple different strategies. So it's not like we look at this every day and we say, okay, we're going to switch all of our money to cash and we're going to switch all of them, right? Like, no, there's multiple strategies we trade. But when a strategy says, hey, based on the indicators this strategy trades on, we think it's time to go to cash. We do. And in the last week or so here, and we're recording this here, in April 2026, but in the last week or so, I've looked at various client accounts, and we hold in some client accounts 50% cash,
yeah,
right? And that's because multiple strategies are telling us that we think the market is going to go down for this particular strategy, and so we go to cash.
yeah,
And we're not always right. We think about it much the same way that a sign is on a freeway. If you're on a freeway, there's a sign that says crash ahead. There's a chance there's a car crash ahead, right? Most of the time, drivers will see that and they'll see the traffic and they'll say, okay, well, something happened up ahead. Now, we've all been driving on the highway, and by the time you get there, there's no car crash. And you're like, well, there wasn't a car crash. Now, are you mad at the sign that said car crash ahead, right? Do you look at that sign and the person who put it up and say, wow, you were an idiot. You didn't know there was a car crash. Obviously, there wasn't one when I went past, right?
yeah,
Well, no, maybe there was a car crash. Maybe there never was a car crash, right? But the reality is that there was a sign that said car crash ahead. And so at that point, as a driver, you can decide to take the next off ramp and find a new route to your destination, or you can stay on the freeway. And by the time you get there, there might be a car crash, there might not
yeah,
be a car crash, you might be stuck in traffic. The way we look at investing is we see the signs and we say, we're going to take an off ramp, we're going to find a different way there. Now, are we always right? No. Sometimes the car crash clears, the traffic clears up, and you've just added 10 minutes to your destination, and you were not the smartest person in the room at that point. Other times, you just avoided 2 hours worth of rush hour traffic by taking a little, 5-minute detour, right? And so sometimes, some years, yeah, we look like geniuses because our strategies work really well, right?
yeah, yeah,
Other years, we don't look like geniuses because it's like,
yeah,
well, hey, if you just invested in the benchmark, you would have done much better than the strategy did. But
yeah.
when you look at over a full business cycle, what we're seeking to do is when the market goes down, stay where we are. So we start from a higher baseline when the market goes back up. And that's really the secret to active management, the way we practice it.
I like that, and I also think it matters consistency. If you do that all the time and doesn't work out, well, there you go. So I think there's something to be said for the consistency. Following with that, understanding like different signals, what's going on in the news, or if you're like strictly technical, whatever that RSA, whatever that looks like. My question is, how do you make decisions? Do you make it based off of headlines, or do you look at technicals? Is there somewhere between the two, or some I'm not even thinking of?
Yeah, well, so obviously some of it is proprietary.
Of course, yeah, of
We're not going to
course, yeah,
disclose it in a podcast.
of course,
Um, Yeah, but I think when you look at the market, just in general, right, there are a multitude of signals that you can choose from, and let me just kind of answer that in more of a process manner,
Okay.
which is really how do you set up an active trading strategy, right?
Yeah.
And what you'll find is there are no shortage of academic papers out there that will tell you how to set up an active trading strategy that generates what we call alpha, which is basically excess return for the amount of risk that you take,
Yep.
right? And so there's a whole slog of the internet basically devoted to chasing additional alpha. In fact, there's a website called Seeking Alpha, right? Like the whole point of money management for some people is generating excess return for the risk you take. And so what you look at is basically, okay, what are signals I can take in? And those signals can be things like headlines, they can be sentiment analysis. Twitter or X now is a great place for sentiment analysis.
Yeah.
Um, I've heard of other hedge funds even using things like satellite imagery for parking lot data in front of
Hmm.
retail stores to get a sense of how retail numbers will come in for individual stocks. So these are all things that you can get for sentiment analysis, you can get for leading indicators on the market, you can look at money supply, right? So there's no shortage of
Yeah.
quantitative and qualitative data that you can plug in. And from that, you generate what's called a signal. And that signal basically tells you what to do in your strategy. And so when you lay out a strategy, right, your strategy could be something as simple as, and this is kind of like our strategies are pretty simple. It's, we'll either go long, which means we buy the underlying asset, hoping it goes up in value. We'll stay in cash, meaning we're holding US dollars, or we'll go short, which means we think the underlying asset's going to fall in value. And so essentially what we do is we borrow the asset, sell it, and then at a later date we buy it back for cheaper than we sold it and we pocket the difference, right? And so it's basically, that's like a long short strategy. It's very simple. You take one of three positions, and so all your signals amalgamate together into a buy, sell, or hold, and then you do that. Now the crux behind all of this, and this is the secret sauce side, um, this is what you pay active managers for, because the strategy I just laid out for you is very simple. But the crux of it is how do you implement?
Yep.
And some of this is, the signals are proprietary or the signals are very expensive, right? I'm not saying we task satellites over retail stores, right? But the hedge funds
Sure.
that do, right? That's a very expensive thing to do, to rent a satellite to move it over a location to take a picture, right?
Yeah.
Most investors don't have a portfolio that justifies getting that signal.
Yeah.
A lot of our strategies that we trade have incredibly high minimums. So to replicate our strategies in your individual portfolio, you'd need over $100 million to invest. And most individuals just don't have $100 million to invest, right? And
True.
so you
Yeah.
have to go through another fund manager in order to get access to those strategies.
Yep.
And the last thing is, well, then how do you actually implement that signal? Like, what security do you buy? Is it, VOO that you're buying?
Yeah.
And the reality is, you can't implement a lot of actively managed strategies with Vanguard funds because they restrict how often you can trade. You
Yep.
can't actually trade Vanguard funds more than a few times a year. That's the point of Vanguard. So you have to go find now another fund that tracks your signal well enough that you're actually getting the strategy you're thinking you're implementing in the underlying securities you're using. And that last part is actually where a lot of people fall down, and their strategies break down because trading costs eliminate any sort of profit they're making,
Yep.
or they can't trade into these securities that they want to actually represent the positions they're hoping to take. And again, that's where, with us, we obviously have institutional agreements. And so we get access to pricing and share classes that your average investor doesn't get access to.
Yep. Yep. So, follow up question. I'm thinking of disclaimer. I don't own this anymore, but I'm thinking of like SPHD, super low cost. Dividends doesn't really go crazy. I used to own it a long time ago. Um,
Mm-hmm.
but my question from that is, being low cost, values there. I get paid dividends. What's the difference between that and what you guys provide? Why should I give you guys 5, 10 million, whatever it is, and not put it in this stock, which is relatively safe?
Mm-hmm. Yeah. So it's a great question. And it really comes down to the individual investor. I believe, and what our firm basically does for people is we take your goals that you want for how you want to live your life, and we help you make your money accomplish those goals as best we can. And for some people, they've got enough money to do this, and for others, they don't. And then we have to basically go back to the drawing board and say, well, given the constraints we have in your income and your money, this is what life could look like. And is that an acceptable alternative, or do we have to find another way forward? Right.
Yeah.
And so, really, at the end of the day, do you want to put everything into, and I looked up that, it's a high dividend, low volatility ETF.
Yeah.
Yeah, SPHD. So yeah, if you saw me looking over here, yeah, I
Nice.
just pulled it up
Nice.
right on my screen just to make sure I'm talking about the right thing. Yeah, it's the Invesco S&P 500 high dividend, low volatility ETF.
Yeah. There it is. Yep.
Yeah. And is that a great place to put your money? For you, that might be,
Yeah.
right? Because the answer is basically, does it accomplish what you're looking to accomplish with your money? Right. And if what you need is low volatility and a high dividend, and this ETF provides a amount of dividend and volatility that is acceptable for your plan and you can stick to it, then sure. Now, should you put $10 million if you have $10 million into a single security? Well, now we get into the
Yeah.
question of concentration risk, right?
Yeah.
And obviously, there are ways to diversify your money and prudent investing, and that's a lot of what we do over here as a fiduciary. Is we basically put on, you know, um, put on a thinking cap that takes you first, because by law we are required to invest on behalf of our clients first and take into account your best interest, not ours. And then we look at this and we say, okay, well, with $5 to $10 million, is there enough liquidity in this fund that we would be able to get $5 to $10 million in and back out without moving the price, right? Because the last thing we want to do is, when we have to sell the $10 million position that you have, we're now moving the price of that underlying security because you are the market, right? Or we can't get your money out fast enough for you to use it, right? And so there's all sorts of other things you have to look at beyond just the dividend yield and beyond just the price action in the last few years.
Yeah. That's a good answer. I like that. I like that. Kind of backtracking a little bit, I just had this thought talking about signals, things like that. Um, Over here in Call Talks, we just talk about red is red, blue is blue. Markets from the markets, and outside world affects that with no opinion on the outside world or whatever that is. What's going on currently politically, especially with the war looming? Not thoughts on the war, whether you're for or against it, anything like that. But how is that affecting markets today that you see?
Mm-hmm. Yeah. Well, one of the things about the global economy
Yeah.
is it is all connected,
Yep.
right? And so, regardless of whether or not you agree with the person who's doing these things are happening.
Yep.
And
Yep.
so, one of the things about investing in money is that you really have to not necessarily care about politics, but you have to care about what is actually happening in the market that day. And what we have seen, is obviously oil. Oil drives a lot of stuff in the markets. And I don't know if you can see here.
Yeah. What's
I've
his
got
name? I
dogs
have
and
to
stuff.
ask.
Yep. So this is Aubergine. She's an English
Aubergine.
Mastiff. Yep.
Mm.
She's the office puppy. So
Oh, that's
yeah,
awesome.
usually asleep on the couch in my office here, but
Oh, that's
she comes
awesome.
over to say hi. Yeah. So yeah, obviously we look at oil, right? One of the big things that the Middle East provides is oil. And when you really think about oil, it's not necessarily gas, though gas is, the price of the pumps is one of the most obvious things.
Yep.
But really, when you look at oil, what you're looking at is the plastics industry, right? And so many things come from plastics, right? And that is actually one of the biggest things when we look at the overall market. That's why people care about this war so much, is by interrupting the flow of oil, you're not only interrupting the flow of gas, which we need for transportation, but you're interrupting the flow of plastics, right? And so when you think about plastics, this isn't just like, oh yeah, there's a plastic, poured plastic, and it's part of a thing I can hold in my hand. This could even be as crazy as like a plastic lining, right? When you start thinking about things like toothpaste tubes, right? The inside of a toothpaste tube, it's not actually metal. There's actually a plastic lining on the inside of it that makes it food grade,
Yep.
right? And that is oil, right? And so that's why this whole idea of interrupting oil shipments is impacting every part of the economy.
Yep. Same idea with and tell me if I'm right or wrong. And the same idea with transportation. To get that toothpaste somewhere, it takes a now. It doesn't mean gas, but the world does run. We ship things, we send things, boat, air, car, and these things increase because for one reason or another, they're off the planet entirely. So that is also reflected in prices. So when you go to the grocery store and you got your satellite taking pictures, there's less people because the price of a toothpaste it's gone up. Not because of the line, well, in addition to the lining, but also to get that tube of toothpaste to you is now more money. Just
Mhm.
plain and how it is. Right or wrong, how far off am I from that?
Yeah, no, that's exactly right. And this is really where, economics comes in and the idea of scarcity, we see it playing out in real time, right? For every gallon of, air fuel, airplane fuel out there
Okay.
that could be used to fuel up a FedEx plane to take packages, could be used to fuel up a UPS plane to, ship cargo, it could be used to fill up a Delta plane to ship people. And this is one of the things that, I recently booked a ticket and I went, holy wow, this is a very expensive plane ticket compared to what I'm used to paying.
Yeah.
And that's exactly what it is, right? Is that I need some gas to move me in a plane from one area to another. And I am competing against everyone else that wants to move stuff, right? This is the local manufacturer who wants to move some of their, screws that they're making
Yep.
over to a larger manufacturer to assemble a car, right? And so I'm competing for the same, gallon of airline fuel, of aircraft fuel to move those parts or me,
Yep.
right? And basically at that point, the economy kicks in and the gallon of fuel goes to the highest bidder, right? And
Yep.
so that is reflected in a higher ticket price. Now, obviously, what happens in that particular case is, Delta goes out and they buy the fuel in advance, and then they increase the price of the ticket to cover the fact that their replacement fuel is going to cost more. But in effect, I'm bidding against a manufacturer to get a plane in the air, and I want it to carry me, and they want another plane to carry their stuff. And so it just comes down to who's got the most money that they're willing to pay. And eventually one of us wins and the fuel goes to that plane,
Yep.
right?
Yep. Yep. And in addition, understanding like that, and I totally lost my train of thought for a second. Sorry about that. Understanding that where money flows, et cetera, et cetera. And the market being androgynous, again, there might be another word, but having belief of everyone. Do you always? We're backtracking a little bit, so be with me. Forgive me. Um, the risk signals that you see, whether it be with this war, oil signals that you see coming in, can they be wrong sometimes?
Oh yeah. Oh yeah. Yeah. Risk signals can definitely be wrong.
Hmm.
There are so many ways to be wrong in the market. In fact, there's more ways to be wrong in the market than there are to be right.
How so?
Right.
Could you tell us more about that? Yeah.
Yeah. So for instance, I'm going to make a statement right now that is 100% correct, and that is the United States is in a recession. That is 100% correct. Now, how do I know it's 100% correct? Because the U.S. will be in a recession, or the U.S. is in a recession, or the U.S. has been in a recession. But the United States is in a recession is a time agnostic statement. Now, the difficulty with that statement is if you start trading on the idea that the United States is in a recession, you could be wrong. For instance, you'd be wrong on timing.
Hmm.
The US is in a recession is a true statement. It may not be a true statement now. It may be a true statement next year. It may have been a true statement 6 months ago, right? It might be a true statement right now. But when that statement is true matters incredibly for the trades you are making,
Yeah.
right?
Yeah.
So this is the thing, right? So if I hold the view that the US is in a recession today, I make certain trades. If I hold the view that the US is in a recession next month, I make certain trades. If I hold the view that the US is in a recession a year from now, I make certain trades. And all I have to do is be wrong about the time that the US is in a recession, and my trades are not profitable,
Yep.
right? Much the same way, the US is in a depression is a true statement. Now, if you know the difference between recession and a depression, it is basically how many quarters in a row you see falling economic output. So if I trade on the US is in a depression and I'm wrong, right? Now, in the temporal sense, right, I lose money. But if I say the US is in a depression and it turns out I'm right in 3 months and I've traded on the time frame of 3 months, right, then I make money.
Yep.
Now, the other ways you can be wrong, right? So that's a scope or a size uh, that you're being incorrect, right?
Yeah.
Recession versus
Yeah.
depression, right?
Okay.
So I could be wrong on time. I could be wrong on the severity. I could be wrong on what it impacts, right? The US is in a recession might be a true statement, but in healthcare, we see a spike in demand for healthcare services. And so while the underlying economy is in a recession, healthcare is a bright spot. Now, if I trade that healthcare is going to be a part of the recession, I could be wrong and I can lose money. Right?
Yeah.
So when you look at these
Yeah.
risk signals, right? Like you
Yeah.
could be wrong on time, you could be wrong on scope, you could be wrong in the industry,
Yep.
you could even be wrong in the underlying security, right? So if I look at something like consumer staples, I've got Kellogg, which makes cereal, I've got General Mills, which makes cereal. And I could say the US is in a recession, consumer staples will be a bright point, therefore I'm going to buy Kellogg, right? And my logic there is everyone will always eat cereal. And that could be entirely correct. And something happens to the executive leadership at Kellogg that causes them to search for a new senior executive. Kellogg goes into chaos as they look for a new leader. General Mills does not. General Mills takes 5% of Kellogg's market. I was right all the way in my thinking, and the implementation was wrong. I bought the wrong company, right? And so you have all these ways that you can be wrong in these risk signals, right? And again, like my risk signals could have been entirely correct,
Yep.
and I implemented the strategy wrong, and I lost money.
Yep. I so I'm gonna I hear this a lot and you're touching on it. So I'm gonna give you this statement and you give me your
Mhm.
thoughts. Uh oh, it's summertime. Uh swimwear is gonna go up. I'll just put all my money in swimwear. Because it's the
Yeah.
summer.
Hmm. Yeah. Horrible idea. Um, yeah. So I actually had a friend of mine. It was a number of years ago. I actually don't know if he still does this, but at the time he was running a number of pop-up Halloween stores, right? Like if you think of
Okay.
like Spirit Halloween, right?
Okay.
Similar
Okay.
idea.
Yeah.
And do you know when you place an order for Halloween costumes?
No. No idea.
Yeah, exactly.
Yeah.
See, and this is why you don't buy swimwear in the summer because everyone wears swimwear in the summer.
Yeah.
You place an order for Halloween costumes in the spring of the year before Halloween. And so he would sit there with magazines and he would have to guess as to what costumes were going to be popular in October, right? Now, you talk about a real fun guessing game. What movies are coming out? Okay, now here we are. This is April. So this is about when you're starting to place orders for Halloween costumes.
Okay.
What movies are coming out between now and October that are going to be popular,
Hmm. Like
right?
Spider-Man, I would assume something like that. Like for today. Yeah.
Yeah, exactly,
Yeah.
right. And so first of all, I don't know the movies coming out between now and October, so I'm not
Yeah.
the right person to be making this guess, obviously.
Sure.
But you got to look at these movies and you got to say, okay, well, what movies are likely to be good, right? Yeah, so Spider-Man, pretty
Mhm.
safe, right?
Yeah.
But who 10 years ago would have called Wicked a franchise, right?
Yeah.
And yet Wicked is popping off, right? And so
Yeah.
if you want to be the cutting edge of Halloween costumes in October, you've got to get lucky and you got to get right in April as to what's going to be the cultural zeitgeist in September, because people will be, you know, prepping for October Halloween in September, right? So you start looking backwards at all these things that you have to get right. Like the movie Ted, right? When Ted
Hmm.
came out, the Ted costume is really popular on Halloween. No one would have seen that come.
Yep.
And those that did had inventory to sell. And those that didn't were left holding the wrong costumes that are now sunk cost, right? And so when you look at that, like as a consumer, by the time you catch on to what's happening, the people who are in the know in that market have already locked in their trades, right? And
Yeah.
Halloween costumes are a perfect example of that because by the time Halloween rolls around, and you get there and you go, oh my gosh, they've got this character from this movie that came out in September. It's my favorite character. I'm going to buy that. The people that locked in that trade did that months ago when they purchased their inventory.
Yeah. For the best profit. You could do it sooner, but it's not the same margins, I would
Exactly.
imagine. Yeah.
Yep, exactly. Yep.
Yeah.
And conversely, fun story. In Halloween costumes in particular, I happen to know this because I asked him, I go, okay, well, what happens to
Okay.
all the stuff that doesn't work out? He goes, oh, you just throw it in storage for the next year and you hope it works out.
Oh.
And so Spider-Man, great idea. That is a perpetual, you will always sell Spider-Man
Yeah, I
costumes.
feel like, right.
Yep. And so, yeah, there's certain things like they're commodities, like witch costumes, skeleton costumes, zombie costumes. He's like, yeah, you just buy those. You know roughly how many you need every year. You just buy a smorgasbord of those and you throw them in storage if you don't sell them. Right. But where you really make a lot of profit is getting that zeitgeist costume right.
Yeah.
Because that's what flies off the shelves. That's like, it's the one year it's hot, the next year it's not. You can mark that thing up. You can take as much profit as you can because everyone wants that.
Yep. It
Right.
makes me think of options. So I dabbled in options a little bit early on. And what you're talking about with timing, I had this exact experience one time. I had the spy call options, zero DT, 0 days to expire. For those who don't know what those are, options saying the stocks can go up. Long story short, that expires that day. And I was like, man, this is gonna go up. I was in college. I was watching all these things. Like, this is gonna work out. Didn't. Spoiler. I didn't make any money. And then the next day, I'm like, dude, I was off. Everything was right. I knew what was going on. I knew. I watched YouTube videos and stuff, but I had an idea that this was gonna pop off. Everything was wrong. Everything was right, but timing. If I would have just waited, and I see this argument a lot for, that's why you'd rather have shares, because shares you can capture that. You're not limited by time, which is gamma, I believe, or delta. You're not limited by time. You're not bleeding money on these options. You have the shares. Your thoughts, shares options.
Yeah. There's a difference in investing in the market for speculation and investing in the market for long-term investing.
Yep.
One of the things that I see people confuse all the time is a casino, speculation, and investing.
Hmm.
When you look at options, options are an advanced financial instrument created to do very specific things to hedge risks. Sometimes you can trade those options profitably without necessarily using them for the purposes of hedging underlying risk, right? So you're basically calling it right as to what the underlying securities are going to be doing
Yeah.
to drive up or drive down the value of options, right? But really, when you enter into the options market, most of the time you should be trading options as a form of risk mitigation,
Correct.
right?
Yep.
Now, if you're going to be trading options as an options trader, right now you're basically just trading risk back and forth and guessing at the
Yep.
direction of risk, right? That is a very different strategy.
Yep.
And I would say that, and I don't say much blanket financial advice because I believe it should be personalized, but
Yeah.
by and large, if you're going to be taking risks like that with your portfolio, don't do it with all of your portfolio
Yeah.
because you're not investing. What you're doing is speculating, right? You've got a theory, you're taking a stance on that theory, and you're seeing it play out in real time, basically based on limited information.
Yeah.
Um, you know, it, there's kind of a scale of information. You go to a casino and you play blackjack, and you know the odds of blackjack if you are counting cards using any sort of a system, right? You can kind of tilt stuff in your favor, but ultimately what you're playing there is a rigged game that the house is going to eventually win,
Yep.
and so you just kind of get out when you can, right? That's gambling, right? If you start having a little bit of knowledge, insider knowledge of how the cards are going, right, maybe that moves a little bit into speculation, because you're kind of making informed decisions at that point. Now, when you go over to options trading, right, same thing. You've got a lot more data. That's speculation. You can start thinking about, well, based on historical numbers or based on charts or based on trends, right?
Yep.
You can start taking positions. And then you get over to investing. And when I look at investing, right, this is more for a 3 to 5 year horizon. This is looking at fundamental factors. This is looking at the overall economy, right? And so your chances of being off on time, by a day are much smaller, right? And
Yep.
really, what you're looking
Yeah.
at there is like, okay, well, where are we in the economy today? Where are we in the future of certain industries? And that's really when you think about your retirement money, right? You should be investing your retirement money, not
Yes.
gambling or speculating with it.
Yes. I'm speaking from my experience on part. I needed it to be where I'm at today, but when I first started investing, I grew up, yeah, rather poor, and I want to change that in my adult life. And so when I got into options, I lost a lot of money. Spoiler. Obviously, I didn't know what I was doing, and I had the wrong mindset because, and a lot of people have this mindset today, and I'm curious your thoughts. They think options trading. I thought this too at one point. I'm investing. I'm investing. I'm in options, weeklies, whatever you want to call it. Wall Street's bets, all these different things, subreddits, YouTube. You hear people becoming millionaires over options. And yes, while this happened, it's not by and large, I agree with you. It's not for everyone. But yes, it does happen. And I thought options meant investing. That's totally wrong because your mindset, options, you're this amount of time, and long term investing in general, this amount of time. Your thoughts?
Yeah, no, I definitely agree with that. Um, and I do see this a lot now, and I say with younger folks, I don't know, I think I'm still kind of on the younger folks side.
Okay.
um, but yeah,
Yes. Yes.
since the advent of Robinhood, right? Like
Yeah.
retail
Yep.
investors got access to a lot of very complicated and
Yep.
complex financial instruments. Um, I again, I don't want to make blanket statements, but I will challenge folks who are doing things like speculating in the markets with a simple question, which is, have you ever used a Bloomberg terminal? And if that question elicits the response, what is a Bloomberg terminal? You should probably stop trading options.
Yeah.
If the answer is no, I've never used a Bloomberg terminal, you should probably stop trading options. And the reason for that, for those of you who don't know, a Bloomberg terminal is a specialized piece of hardware that every major investment firm on Wall Street uses, and every trader on Wall Street has access to. And they are very, very expensive, tens of thousands of dollars. And they are how you access very detailed information about the markets. And I've had the luck of being able to access Bloomberg terminals before. They are awesome. They really make trading great. I have yet to find another software that comes near to it. And the reason for that is just the amount of data you can get, right? It's insane. Um, but it points to a more fundamental thing of like, look, if you don't know what a Bloomberg terminal is, you don't really know the industry. And if you've never used one, you've never really actually been in the industry of trading,
Yeah.
right? And when you're doing speculation, when you're doing day trading, when you're doing short-term trading, if you don't understand the people you're playing against, like you are going to be eaten alive, right? Like
Yes.
if
Agreed.
you think you're the predator, and if you don't know the predator's vernacular, guess what? You're the prey,
Agreed.
right?
Yeah.
And so people who are in the know love retail investors because they're dumb money, and you just lose on those trades. And there's someone on the other side of the trade who's you know taking that money. Um, and so really, when you look at stuff like that, you know you have to decide where you're going to play and with what amount of money. And if you're going to do speculation on the chance that you want to get rich, then you should be taking risks that are going to get you rich, but recognize that there's intense wipeout risk. And so
Yep.
you should have stability really pretty much everywhere else. This gets back to one of the fundamental principles that I talk about with my clients when it comes to taking risk is what is your risk capacity and what is your risk tolerance? So the first one, well, I actually was in reverse order. Risk tolerance is how much can you lose before you feel bad, right? Some people say, well, I can lose it all before I feel bad. Okay, that's great. Very few people can actually lose it all before they feel bad, right?
Yeah.
Essentially, risk tolerance is like how much you have to lose before you're losing sleep at night. And the second is risk capacity, which is how much you can actually lose before it starts impacting your life. So this is especially important for folks who are doing, day trading or short-term trading, who are younger, who don't have a balance sheet in the millions. Your risk tolerance may be incredibly high. Your risk capacity is you can't lose the rent money. And if you've lost the rent money and you're not freaking out, then you have a very high risk tolerance with a very low risk capacity. And that is a very dangerous place to be because you are willing to lose your shirt when you cannot afford to lose your shirt,
Yeah.
right? Someone who can lose $1 million in the market does not have $1 million in their bank account. They've got hundreds of millions of dollars in their bank account,
Agreed.
right?
Agreed.
And so, that's the industry you're going into, right? When you talk about risk capacity and risk tolerance, when you're doing short-term trading, you're going up against guys who are professionals, right? Their risk tolerance might be the same as yours. Their risk capacity. You ever looked at the balance sheet of some of the major banks, some of the major asset managers?
Yeah.
They're not managing millions of dollars. They're not managing billions of dollars. They're managing trillions of dollars. That is a incomprehensible large sum for most humans, right?
Yeah.
And so if you're sitting there with 25 grand to your name, you're playing in a world where table stakes is billions,
Yeah. You're not
right?
even on
Like,
the, yeah.
yeah, you're not even close to being on the map. You are
Nope.
so far in uncharted territory, right? And so just some words of warning there. But when it comes to risk, if you want to do it, that's great. Do it. If you like going on Wall Street bets and you like making bets and you like seeing what's going to happen,
Sure.
awesome. Do it. Carve out a portion of your portfolio, set your maximum loss, and say, here's what I'm going to do. And then have a plan when you lose that money. What are you going to do to refill it?
Yep.
Right. And that might be keeping a stable job. That might mean you go in 9 to 5 every day to earn money so you can do prediction markets, you can do sports betting, so you can do Wall Street bets,
Yeah.
right?
Yep.
But you don't want to take risks in every part of your life in both your job and your investing. So
Yeah.
pick an area you're going to take risks and then keep the rest stable because as they say in, I think this is a quote from Wall Street now, um, but basically the markets can remain irrational longer than you can remain solvent. And you want to make sure that when the markets are irrational and you are insolvent, you're not also homeless because that really puts a
Yeah.
damper on coming back.
I would agree with that. I'm noticing time, but I have to ask all these things we talked about philosophies, ideas, strategies, risk. I'm just going to say it Bitcoin. What does that look like? Yay, nay, not happening, never happening, solid. What do you think?
This is another one of those great statements where time is
Mm,
the thing that mattered. Bitcoin is a great asset, and I certainly think that it has served its purpose well. Bitcoin will not make you a millionaire anymore. I've been in Bitcoin since Bitcoin was $100 a coin.
wow.
I've been around Bitcoin a long time. And don't worry before anyone listening to this goes, wow, this guy's really, really rich. I I more than doubled my money in Bitcoin.
Mm,
I bought it at 300 a coin and I sold it at more than 600 a coin. Right?
yeah.
That's amazing. I made a huge killing.
Yeah.
Great ROI. Now, if I just held on to it for another 5 years, dot dot dot.
Yeah.
But at the time I didn't know that, and I ended up paying for a nice 5 week vacation to Europe by selling my Bitcoin. That's pretty awesome, right? Like
Agree.
now, of course, today I could have a fleet of Lambos and living in Europe, but whatever. You make the decisions you make.
Yeah.
So look, I don't think crypto is going to make you a millionaire anymore unless you're trading in esoteric, thinly traded coins. Like Bitcoin's not going to make you a millionaire anymore.
Yeah.
If you invest today, it's not going to turn $10 into $1 million. So you got to look at Bitcoin as like any other asset class now and say, okay, well, what is the underlying use? Do I believe in the crypto economy? Right now, Bitcoin is a reflection of the crypto economy.
Yep.
Is an easy way to take kind of a broad market bet on crypto as a whole. That being said, there are also publicly traded crypto companies out there, right? If you want to take a broader market bet on crypto as a whole. But really, if you're investing in Bitcoin because you want to double your money, I think you're in the wrong asset class at this point in time.
I would agree. Yeah. I had the luck, not Bitcoin. I wish, dang it. But another crypto Raven coin. Very much the same. I'm not smart. It was just luck. Happens. paid school debts, things like that. But yeah, much the same. It's esoteric. It was totally a chance, but I think that you've been seeing a lot of conversations. There's a lot of podcasts, a lot of investors who talk about BTC, and it's interesting. I don't know how old you are, but I would definitely say you seem like in the younger people, like Warren Buffett, for example, and in his generation, they hate Bitcoin and they're very outspoken about that. But as you go down more younger, I believe in Bitcoin. I see time will tell as a store of value where that will lie. Doesn't make you a millionaire, but there seems to be a divide among this. So I always like asking, getting thoughts um, on that. But I, Adam, we are getting close to time. I want to respect your time. Um, Thank you. I do this part. It's called Dear Next Guest. So my previous guest leaves a question for my future guest. You answer it, and then Adam, you will leave me a question to my next guest, and it can be about anything: favorite foods, controversial opinions, about anything. So my last guest, Monica Guzman, who's been TED Talker, published author, has this question for you. Dear next guest, what is an unpopular opinion you have?
Unpopular opinion that I have. Um, I think that you should pay for house cleaning services a lot sooner than most people think.
Hmm.
And my reason for this is the only thing you have in life is time. And if you want to spend that time cleaning your bathroom, that's great. But if you got $100 and someone's willing to clean the bathroom for you, give them the $100 and go do something else with your Saturday. Um, that's
Fair
that's
enough.
how I live. We've got a cleaning service, and I spend my weekends with my family, and pursuing my activities. And thank God for my cleaners because they come in and they handle that for me. Um, and that's there you go. That's how I'd answer that.
Okay. Next question you for our next guest. It can be about anything.
Yeah, yeah. But okay, so here's the question I'd ask your next guest.
Okay.
Um, would you be the type of person to change your own oil in your car for your entire life? Why or why not? And I asked that because I just got an oil change in my car and I
Okay.
saw how much it cost. And I was going, I think this was a good use of my time.
They're very, very for something you do yourself. So I actually like this question.
Yep.
I for the foreseeable future, I will do my own oil. But yeah, it's yeah, it gets crazy. But that's a great question. Thank you, Adam. I'll ask my next. Thank you so much for your time, for your insight into strategies, tools, risking, crypto, all these things, mindset on what it takes to win. If someone's listening to this and says, I like his ideology, I want to get in contact, maybe have a deeper conversation, where can they do that at?
Yeah. So you can find us online at fireweedcapital.com. You can also email me directly, adam@fireweedcapital.com. I do respond to all emails personally. So certainly, if you're the type of person listening to this and you're thinking, hey, I want to do something with my financial life, I love working with families who are seeking to make themselves better financially. That's my jam. So I'm here to help your family achieve the goals you want. That's what I love doing.
Awesome. Everyone, that's Adam. Thank you so much for your time.